What is up, guys? In today's video, we are going to go over the basics of taxation in Canada, including income tax, capital gains, dividends, how to reduce your taxation as well. So stick around to the end because I'm going to go over that, how to file your taxes, how to figure out your tax rates. So it'll be a bunch of things, and I really enjoy this subject matter, so I'm excited for it. So with that, let's just get right into the video. Okay, Benjamin Franklin. Nothing is certain except for death and taxes. My man said that maybe 100 years ago, and it still rings true to this day. Taxes are a necessary part of life. Whether you like it or you hate it, we have to pay them. So understanding how they work and how you can reduce your tax bill as much as possible is really important. So interesting fact here, actually in Canada, we tried to postpone income tax as long as possible. Other countries were charging income tax and we weren't in Canada here, pardon me. But in 1917, we actually did implement a income tax just to help pay for World War I, and we are in 2022 right now, so we understand that, well, it didn't quite work out as a temporary war relief. We're still paying it to this day, but it does fund this beautiful country that we live in, all the infrastructure, all of the things that we take for granted, healthcare, et cetera, et cetera. So like it or hate it, it's here. So the basics of how taxation works in Canada is the CRA classifies 6 different types of income. And depending on what type of income it is, it has a different mechanism by which it's taxed. But overall, we have what's known as a progressive tax system in Canada, meaning that the more that you make, the higher your tax rate is going to be, okay? So let's talk about these 6 different types of income. So the first type of income is just called other income, which is ironic because I would argue that it makes up the bulk of income in Canada. So other income includes employment and it includes interest. So employment is salaried income. So that if you work at a job, that's gonna be your income. If you're self-employed and you pay yourself a salary, if you have a corporation, you pay yourself a salary, that's gonna be other income as well. That I would say makes up the bulk of income within Canada, and that's taxed at 100%. The next one we have is capital gains. Now, capital gains is when you sell off some type of capital property. That could be real estate, that could be a stock, that could be some other type of capital property. And when you sell it off, how this works is essentially what you sold it for minus what you bought it for is going to equal a capital gain. And it can get a little bit more complicated than that, but I'll give you a really easy example. Let's say that you invest in Apple, okay? And let's say you buy a share of Apple stock and you buy it for, hypothetically, $100. And then that stock accrues in value and it goes up to $250 in value. At that point, you sell this stock, you wanna take your money out and you wanna go spend on something else. You will then have a $250 sale minus what you bought it for of $100. So that's 250 minus 100 is $150. This is what's known as a capital gain. Now, this is where it gets a little bit confusing. In Canada right now, we have what's known as a 50% inclusion rate. That means that only 50% of the capital gain is actually added to your income for that year. So we have a $150 capital gain. We only take 50% of that. So $75 would then get added to your income. The next 2 types of income that the CRA classifies is dividends. And so we have 2 different kinds of dividends. We have eligible dividends, and that's essentially a dividend from a large corporation. If you have any type of stock with a large corporation and they're paying you a dividend, chances are it's going to be an eligible dividend. The next one we have is a non-eligible dividend. That's usually from a small Canadian-controlled private corporation or a small business in Canada. Now, I'm not gonna talk about this too much in this video because I did make another video, and I'll put it right there, about how dividends are taxed because they are a little bit complicated, but I will put that video there and you can check that out. Now, the last 2 types of income that we have here in Canada are specific to corporations. So we have what's known as a general rate, corporate rate, okay? And that essentially is income over $500,000 in a corporation, net income. And the second one we have is something known as this small business deduction, and that's income under $500,000 within a corporation, net income, of course. And I'm not gonna talk about that in this video because, again, I made another video about how corporations are taxed, and I'll link it right there if you're interested. But the main difference with corporate income versus personal income is, like I mentioned, progressive, meaning that the more that you make, the more that you're going to be taxed, whereas corporate income is not like that. It's flat tax, meaning that under $500,000, it's the exact same amount, and then over $500,000, it's also the exact same amount, depending on whether it's your general rate, corporate rate, or your small business deduction. So those are the 6 different types of income, and depending on which bucket you fall into, you might have to worry about a couple of them. However, chances are, if you're just a salaried employee and you're working for a corporation, the only one you're really going to need to worry about is that other income, okay? Now, let's talk about tax brackets, and I'm going to try my best to explain this in a way that's super simple and you'll understand, and I think I'll be able to do it. So in Canada, we have 2 different tax rates. We have a federal tax rate, and then we have a provincial tax rate. So the federal tax rate is the same across Canada. We might have different buckets and different marginal tax rates, but wherever you live, it's gonna be the exact same. Now, the provincial one is specific to what province you reside in. So what you need to do when you're figuring out your taxes is you need to take the federal tax rate and the provincial tax rate of where you reside and put them together. So what I'm gonna do is I'm actually gonna show you a few things on the computer of these different tax rates, and you can really visually see exactly what I'm talking about. So this is just the Government of Canada website. So you can see here federal tax rates for 2022. Now this is where there is buckets of taxation, okay? So right here, it says 15% on the first $50,197 of taxable income, okay? What that means is that just federally, if you make under $50,197, you are only going to pay 15% federally. After $50,197, you're gonna go into the next tax bracket, meaning the next dollar that you make will be taxed at 20.5%, okay? Now that doesn't mean that all of the income previously is going to jump up to 20.5%. It's only the new dollar, the dollar over $50,197 that will be taxed at that. Now, you may have heard of marginal tax rate versus average tax rate. The most important thing you need to know is marginal tax rate, and that is what your next dollar is going to be taxed at. Average tax rate is essentially if you add all your income together and then you would divide it by what you paid in taxes to get your average tax rate. And it's not as important of a number as your marginal tax rate, because your marginal tax rate is essentially how much you're going to pay on the next dollar. And the more money you make, we know that we have a progressive system here in Canada, the more you're going to be taxed. So at a certain point, you might say, hey, I'm not gonna take this dollar this year. I'm gonna wait until I make less money next year and then I'll take it because the taxation may just be too high. So this is the federal tax rate. If we scroll down here, we can see the provincial tax rate is also on this canada.ca website. So we can go down and look up different provinces. Let's take Alberta, for example. So Alberta is quite simple. I reside in Alberta, but you can see here 10% on the portion of your taxable income that is $131,220 or less. So that's quite simple. It means that if you make under $131,000, provincially, you're going to be taxed at 10%. So if we go back up to the federal tax, you can see that if we made $50,197 in Alberta, we would have a 15% tax rate federally, and then we would have the 10% provincially because we're under that threshold, meaning our marginal tax rate would be 25%. And then of course, if we went over that 50,197, it would jump up 5.5% and would be in the next higher marginal tax rate. Before I go on, I want to quickly tell you guys about Affinity Life. So Affinity Life is an online life insurance marketplace where you can actually view quotes online without having to put in any information like your email or your phone number so we harass you over the next couple weeks. It's not like that. You can just view them 100% without putting in any information besides your birth date, obviously, and you can apply 100% online as well. So if that sounds interesting to you, I'll put the link in the description below, and yeah, check it out. So let's talk about deadlines now. So when are your taxes due? Well, if you're an employed individual, your payment and file date is going to be April 30th every year. So that means you need to file your taxes and have them paid before April 30th. After that, you're going to start to incur penalties and fees, and you don't want that. If you're a self-employed individual, however, you will need to pay by that April 30th date. However, you have until June 15th to file your taxes. So they give you a little bit of wiggle room there because I understand that self-employed individuals might have a little bit more complicated of a tax return to do. And if you're a corporation, they'll give you usually 2 to 3 months, depending on how large a corporation is, to pay for your taxes after your year end. Now, corporations are a little bit different because they can choose their fiscal end. It doesn't necessarily have to line up with any date. So it could be June, July, August, September, October. It could be any month they want, but usually it's 2 to 3 months that they have to pay after their fiscal year end. And then they usually have 6 months to file their taxes. So they have quite a bit longer to actually file their taxes, because corporations are probably the most complicated for tax returns, so they do give them quite a bit of leeway in that regard. Okay, so let's talk about reducing your tax rate. How can you reduce your taxable income and pay less taxes legally in Canada? Okay, so the first two are for business owners and self-employed individuals. So the first thing is, if you're a self-employed individual as a sole proprietor and you're making a high income that you don't necessarily need all of, maybe it's time to incorporate and start a corporation and have your income go into the corporation, because corporations are taxed at a lower rate, and then you can just take out whatever you need personally. And I made another video on whether or not you should incorporate, is it the right time, and I'll put that video there. That's one way. If you're a sole proprietor and you're not using all your income that you're making, starting a corporation and keeping that income in there will be taxed at a much lower rate. It's very valuable. The second one that you can do is start a sole proprietorship. So if you are an employed individual and you have aspirations to do some type of side hustle, now this side hustle could be selling things online, or maybe creating a course, or maybe selling something at a farmer's market, or doing something, okay? Now the benefit of having an income from a job and a sole proprietorship, this is where it gets really interesting, because of course, any profit that you make from the sole proprietorship will be added to your overall income for the year. So let's say you make $60,000 at your job, but you made $10,000 at your sole proprietorship. You would get taxed at $70,000. However, this is where it gets really interesting. If you have expenses within your sole proprietorship, which most business owners do when they're first starting out and they have expenses and they're launching and they're trying to create something, they have more expenses than profit. Those expenses can actually be used to offset your income from your job. So let me explain this real quick, okay? Let's say, again, same example, you have $60,000 that you made from your job, your 9 to 5, but on the side, you're building this sole proprietorship, this business, and you may have made $10,000, but you had, let's hypothetically say, $25,000 of expenses. Well, that means that $25,000 minus the $10,000 is $15,000 left over of expenses. At that point, you can actually use those leftover expenses to write off income from your personal job, meaning that you got taxed at that $60,000 amount, but you're gonna go down to $45,000, and assuming that we're taking deductions off your paycheck, you'd get quite a hefty tax return back. So if you're a employed individual and you're thinking about starting a business, absolutely, it's a great idea. If you start a sole proprietorship, you can use a lot of those expenses to offset the taxes from your income from your job. The third way that you can reduce your tax bill here in Canada is by the use of an RRSP or a TFSA, and I'm going to be making another video and several videos actually about those, so stick around for them. If they're not right there, they will be there soon, but RRSPs and TFSAs are a great way to reduce your taxes, both on investments as well as your taxation on your income in Canada. They're absolutely great tools. Real quickly, how they work, if you're not familiar, an RRSP, when you contribute to it, will receive a corresponding tax deduction. So let's say you put $5,000 in your RRSP, well, that's reduced from your overall income that you made from your job. So again, if you made 60, it would now go down to 55 and you'd get a great tax return. Also, any returns within your RRSP are tax-free until you pull it out. Now, a TFSA works a little bit differently. A TFSA doesn't get any corresponding tax deduction. However, anything that accrues within that, any returns is all tax-free, plus you can take it out tax-free. Just a little bit different. I will be making videos on that, so don't worry about that. Now, the last one is to maximize all your deductions. If you're not using all your deductions, you absolutely need to be doing that. So if you go on the Canada website, there's a list of all the deductions here in Canada, and I'll put the link in the description so you guys can check that out. But just a few of the popular deductions here in Canada. Charitable donations are a deduction. Medical expenses can be a deduction. Union dues can be a deduction. RRSP contributions, like I mentioned, those are deductions. If you're not using those, absolutely use those. Childcare can also be a deduction here in Canada up to certain limits, and capital losses can be a deduction. So Like I mentioned at the beginning of this video, if you bought that stock in Apple, let's say that it went down to $50, so you bought it at 100 and it went down to $50 and you sold it, you would now have what's known as a capital loss. Capital loss is different than a capital gain. Capital loss can be used to offset your income, and again, you'd get some of those taxes back when you paid them on your salary. Now, one of the last things I'm going to show you here is how you can actually estimate your own taxes, and I mentioned we go to another website. So that website is taxtips.ca. And this is a phenomenal online tax calculator that has a lot of great resources on the website as well. There's quite a bit of ads, so kind of navigate through the ads and be careful what you click on. But the website is really phenomenal. There's a lot of good information, and I'm not sponsored by them at all. I've just been using them for the last decade now for any different tax information, tax tip that I've been looking at. So let's just go here and then I'll show you this online calculator, and you can go here to essentially calculate your own taxes that are payable. So they add everything for you, which is really nice because it can get quite complicated to add up all the numbers. So you can see here, we have employment and other income. So again, that would be your salary, okay? Capital gains, if we had any capital gains for the year, and then they have eligible dividends and non-eligible dividends. They don't have the corporate tax rates here just because they're a flat corporate tax rate, but essentially if you wanted to do that, that's quite simple because it's flat. You could just look up the rates and apply that against your corporate income. So let's actually put in some numbers here and I'll just show you real quickly. So let's say we made 80,000 here. You can see very quickly, they have all the provinces and they already have the federal and provincial combined. So Alberta, we'd be paying $17,543 in combined taxes. Average tax rate's not as important as others. This is what you really want to be looking at, your marginal tax rate. That means if you make another $10,000, it's going to be taxed at 30.5% because you're in the next bucket, and that's combined both federally and provincially. We know that the federal is at 20.5% and the provincial is at 10%, just from that diagram earlier on the Canada website. So this gives you a really good idea. You can see capital gains we know is taxed at that 50% inclusion. That's why it's 15.3. And then dividends, I mentioned they're a little bit more complicated, but they're right here. So this is a really easy way for you to put in your salary and other things. Maybe you wanted to sell a stock. Let's see what that would look like if we had an extra $10,000. So we know that it's 17,543. If we took it, you'd see it goes up to 19,000. So we're paying about another 2,500 of taxes on that $10,000 capital gain, maybe 2,000, roughly 2,000, pardon me, in taxes on that capital gain. So maybe it's worth it this year or maybe wait till next year. Last thing I'll mention real quick is filing your taxes. So of course you can file your taxes with any accountant. There's also a ton of online resources to file your taxes online, TurboTax and a bunch of other ones. But one that I found that I actually haven't used it yet, but it's really interesting. Wealthsimple has a free tax return software that they offer. And at the end, you can donate if you'd like to, but you don't have to. It's totally free. Of course, they're using this as a marketing tool for their own company because they essentially want to get young people in. They're looking to do their taxes online and then also invest online. But listen, that's another story. I'm not sponsored by them at all. I just thought it was a pretty cool tool that you can use for free. And yeah, that's kind of cool. So with that, I hope you guys enjoyed this video and I hope you guys got something from it and I didn't totally confuse you. If you guys are enjoying this content, all I ask is that you give it a thumbs up and I'll see you guys in the next one.